slightly later than I would have liked to do. Usually when we have a budget, there's a raft of stuff in the press, on the news, there's publications, people have seminars. I like to leave it a while, usually a month, although this is a lot longer. But Christmas got in the way, and then we tried to do this in early January, and the weather scuppered it, so here we are on the 27th of Jan instead. But I like to look at things in a bit more depth. It was quite an interesting budget, first one Labour have done for many years. The highest ever tax take as a percentage of the country's GDP. And I think they promised £70 billion more spending every year. And the bulk of that, as we all probably know, is from the national insurance increases. Now, that is one topic I'm not going to talk about this morning, although it is big, but it isn't rocket science. It pretty much is what it is. It'll be interesting to see how it pans out, or it's already panning out. You know, will wages, will it depress wage rises because the employers have to cover the increased national insurance costs, or will it cause inflation and everything we're buying is more expensive? And it'll probably be a combination of the two. But given that most people in this room are probably consumers and employees, I think either way we'll pay for it, whatever happens. So I think we'll be stuck with the bill ourselves. So like I say, I'm going to take a deeper look at some of the bigger announcements in the budget. Given where we are, most of Hart Shaw's clients are SMEs, local. I think if you draw a line 50 miles around the office, you probably capture most of them. We do have them further afield than that. So I've tried to emphasise the effects of the budget that would affect SMEs and their owners. I wouldn't pinch this slide from a lawyer, but the point of it is I'm not going to give you advice. I'm going to point out some pointers, and if any of this piques your interest because it's specific to you, by all means have a chat with one of us afterwards. Seek advice from where you'd normally get advice, but this is just to hopefully just give you an idea of the kind of things you need to be thinking about. If the stuff I'm going to talk about doesn't affect you, then I hope you find it interesting anyway. So I've divided it into two parts. The first part, I'm going to cover those four topics in probably less detail than the second part. I won't say anything about them now. Those were some specific announcements. In the second part, I'm going to look at the changes to capital gains tax and the changes to two reliefs for inheritance tax, which are very similar, agricultural and business property relief. There is a case study as well, so that comes on after the first part. Employee ownership trusts. Now, hopefully, everybody in the room is aware of what an employee ownership trust is, what they're for. I am planning to do another seminar later in the year on looking at only employee ownership trusts. So it's the benefits, why would you want one? What are the benefits of having one? What are the conditions? The reason I've put it up now is to flag them up, but also they announced some anti-avoidance rules in the budget. And I'll come on to a bit more detail about that, and I'll also say a bit more about what they are as well. So think John Lewis and then forget John Lewis, because they're all about employee ownership, but they're nothing like the John Lewis model. But basically what they were introduced to encourage employee ownership in the businesses that they work for. But one of the attractions for the vending shareholder, predominantly in SME companies, is that they can sell the company to an employee ownership trust and not pay any capital gains tax whatsoever. Now, there's been a perceived abuse of this. Abuse is probably a strong word, but the government perceived that people's motivation for forming one of these is driven more by the tax and less by the altruistic, I want the employees to benefit from owning the company. Now, the employees do not own the company. The trustees own the company, and they are there. The stewardship of the company is to make sure that it is run for the benefit of the employees. The board of directors still own the company. The vendors sell the shares to the employee ownership trust trustees, and then they run the company. The directors still continue to run the company, but the vendors can stay on as a director. They don't have to. And the point is that the employees do not own the company, but they do have certain tax benefits that they can benefit from once the company is owned by an employee ownership trust. Like I say, we're going to do a whole session on that later on in the year, but they've tightened up the rules because of the perceived misuse of them. And it comes, I think, because they want people to focus on the altruistic, encouraging employee ownership rather than, great, I can sell my company and not pay any tax. I don't understand why they didn't think that people would want to use them if they don't pay any tax, but there you go. So what have they done? They've tightened up on some of the rules, and these changes were effective immediately. The first one is, we always say to clients, if you're selling, very often these things are sold with deferred consideration because the company know the trust borrows money, they cannot afford to pay the full price of the company to the vendors up front, so the payments are made over many years, or typically up to 5. So that we always say to the former owners, if, say, for example, there's 2 shareholders selling out, you stay on the board of directors so you can keep your north eye on what's going on there. You go on the board of trustees of the ownership trust so you can keep your eye on what's going on there until you've had all your deferred consideration. Then resign by all means, or stay on if the team still need your expertise. And the government perceived that people were trying to control the company via the trust, so they've said that the trustees cannot predominantly be the former vendors. The third one down is quite interesting because there is a perception amongst HMRC and the government that people are overinflating the price that they're selling their company to the EOT. And we at Hart Shaw, we tend not to value the company if it's our client that's going into the EOT, we get somebody else to value the company. But obviously you need to value the company to make sure that the price the trustees are paying is fair. And they've said that the trustees need to take those reasonable steps. The clawback period's been increased, so the conditions have to be in place for a certain period. That's going to 4 years. And another interesting one, second to bottom bullet point, when the vendors put details on the tax return, obviously there's no tax to pay, but they have to put certain details on which will allow the HMRC algorithm to pick them up and then open an inquiry if they feel it appropriate to open an inquiry. And I don't think, the bottom one's probably worth a minute on. One of the conditions, one of the benefits for the employees, they are allowed a tax-free bonus annually up to $3,600, and that has to be for everybody. You can discriminate on certain factors, but they've relaxed the rules to say, well, if the board of directors or any of the directors do not want that bonus, that's absolutely fine. Whereas the rules as they were originally enacted, everybody has to participate in this bonus or you're breaching one of the rules, and it ceases to be a qualifying EOT. And there are loads of other conditions you can breach as well. But like I say, I'm going to do a full 30 to 40 minute session on that later, hopefully in the spring. So look out for that on our social media feed. So the point being, they've tightened up the rules and we just need to be a bit more careful when we're setting these things up so the benefits aren't clawed back once the company's been sold to the EOT. Inheritance tax on pensions, another change announced in the budget. This isn't effective until April 2027, so you're fine if you die before then. Hopefully we all look quite healthy, so hopefully we won't, so this will concern us. And in a nutshell, most pension pots, if drafted correctly and you seek the correct advice, could avoid inheritance tax on death, not the case from that date. So what that means is if you die with quite a sizable pension pot, then that is now part of your estate for inheritance tax purposes. Now, the government have said that they were going to have a period of consultation on this, and I think they need it because it will mean that the personal representatives will need to interact in quite detail with the pension scheme advisors, the PSAs, I think it's referred to on here. So what will happen is when somebody dies, the personal representatives will need to tell the pension scheme. Obviously, the pension scheme then value the scheme, tell the personal representatives. The personal representatives account for the inheritance tax, get the inheritance tax return in, pay the tax, pay the portion of the tax that doesn't belong to the pension scheme, tell the pension scheme advisors how much tax they've got to pay. The pension scheme advisors then pay the pension scheme portion of the inheritance tax for the entire estate out of the pension scheme. Then they pass what's left on to the recipients of the pension in the will. Now, there are a number of problems with that. The first one is very often, say for example that's already happened, and then there's a deed of variation which could happen. Very often for larger estates, HMRC will inquire into the inheritance tax return and there may be more inheritance tax to pay. So what happens if the inheritance tax bill's gone up the personal representatives tell the pension scheme administrators, you've got more tax to pay, and they've already paid the scheme out to somebody else. And it's quite interesting because in the budget notes there was a commentary that said HMRC, that's the we are interested in how beneficiaries can be contacted if further inheritance tax amendments are required after the pension's been paid out. So they don't know what's going to happen yet. So I think this would be quite interesting. And also, I think it would be very interesting. We see clients who they don't use a solicitor or an accountant; they do it themselves. Well, they know they've got to do all this. So I think it'd be quite interesting when it all comes into force. Stamp duty, land tax. Again, I'm not going to dwell too long on this, but we all know what stamp duty, land tax is. We all know it's paid on property purchases. The change was for people buying second residential properties. So that might be a buy-to-let, it might be a second home. And the rate, the table rates for buying your first property are exactly the same as for buying a second property, but they were 3% higher across all the rates. They're now 5% higher. It also applies to companies who are buying residential properties worth more than 500,000. That's going up from the same percentage increase of 2% from 15 to 17, and that's already in. So I'm not going to dwell on it, but there's the numbers, and there is a rate change. There's an extra band coming in from the 1st of April. But if you look at these are for the second property, and these are all 5% higher than if you're buying your first property. Company car benefit. Scott, wave your hand if he's not hiding. Scott put these together for me, and it's quite an interesting read actually, because there were two changes announced, which I think will be quite interesting when they pan out. So it's probably just worth spending a few minutes. That is a Ford Ranger, I think. So from the 6th of April, the reason these are being talked about is double cab pickups are quite interesting from a company benefit in kind perspective. So if you're an employee and you're provided one of these, then you will pay benefit in kind income tax on the value of the benefit in kind. Now, historically, anything less than a tonne has been taxed as a car, and anything with a payload of greater than a tonne is taxed as a van. From the 6th of April, they'll all be taxed as cars, which makes quite a difference to the amount of tax individual employees will pay if they are provided with one of these to use by their employer. So Scott put together an example. Ford Ranger, he said, well, the list price of this one is $38,650. In this case, we're saying that private fuel is also provided by the employer. Now, if you did the maths on this one and they were being properly advised, you'd tell them not to do that. But for the purposes of making the numbers a bit more stark, let's assume that this person also has some private fuel provided by their employer. The emissions of this one are 220 grams per kilometre, which affects the benefit in kind that they're paying once it's a vehicle, once it's a car, not a van. And let's assume this person's a 40% taxpayer. Now, there's a lovely spreadsheet behind all this, which I'm not going to go through. But now, under the old rules, the van benefit, this is the tax. So what we do is we calculate the benefit in kind, which is linked to the table rates or to list price, depending on what you're looking at. And then you calculate the benefit, that's the gross, and then you apply the employee's marginal rate of tax, which in this case we've said is 40%. So this particular person will pay just under £2,000 worth of tax per annum to have that vehicle, the benefit of driving that vehicle. Now, when the new rules come in, that will change to nearly £10,000 per annum. Okay, now, which is eye-watering. And I practiced, my wife's an accountant, and I went through this with my wife at the weekend, and she went, "God, that Scott's a bundle of joy, isn't he?" Sorry, Scott. So yeah, eye-watering numbers. Like I said, you probably wouldn't have the private fuel element if you're advised properly. You'd probably just put your own fuel in and then claim for business mileage, so that 4,000 would disappear. But in this case, it goes from just under 2 to nearly 10. There are some knock-on effects for both employer and employee. The benefits itself, so if we just go back to the previous slide, not the tax that's on this page, the grossed up figure, so that divided by 40%, that is added to the tested income for the high income child benefit charge. So what you can see here, that will take a lot of people into that charge, meaning that their child benefit is clawed back. And the tested income, in our example, it goes up by about 10,000 if the individual doesn't receive private fuel from the employer. It goes up by 20,000 if they do. Okay, there is some good news later, don't worry. So very expensive. So not only are you paying more tax, you've also potentially got your high income child benefit. So you can imagine if you are on 55,000 per annum with 3 kids and you've got one of these, the tax could be up to £11,000 more per year. So you clearly need to do something about that, I think, if you've got one. That's quite a chunk of your take-home pay. For the employer, the knock-on effects are employers pay another form of national insurance on benefit in kinds provided to employees. That goes up from 13.8 to 15. And using the same example, the point is they pay the tax based on the value of the benefit. Now, as we saw, the gross benefit figure had gone up for the employee, and the employer pays this national insurance on the same figure. So their national insurance cost for the employer goes up from $615 to $3,710 per annum because of the increased benefit value. The other thing is vans are fully expensed in 1 year for capital allowance purposes, so you get the full benefit against your trading income, and for cars they're not, most likely to be 6% at that level of vehicle, possibly 18 if it's 50 grams or less per annum. So the cost of the vehicle, 6% of that on a reducing basis per annum is allowed against your trading profits instead of the whole thing being written off in year 1. So again, you're losing out there. So the good news is this doesn't come in, well, it does come in straight away, but if you've got one already, it doesn't apply until you buy your next one, or if you keep it until the 5th of April 29, it doesn't apply until the 5th of April 29. And it only applies for new ones purchased, leased or ordered at the end of the tax year, before the end of the tax year. Sorry, the existing rules apply until the end of the tax year. So get one now is my point, and then you'll have another 3 years. You'll have another period of grace until you get your next one. And then a slight change to hybrid cars, although I don't like usually talking about these kind of changes because they don't come in until 28, 29 now. There might have been an election by then, and I think a lot of stuff that's announced in budgets these days is political rather than fiscal. So I will spend a couple of minutes on it, but at the moment there are beneficial benefit in kind rates. So if your employer provides you with one of these as a benefit in kind, then at the moment you'll be paying less than you would have done if it was a regular fossil fuel car. Well, they're all being aligned in 28, 29, but like I say, let's see what happens, because that's quite a way away yet. So then on to part 2. So we're all probably aware that the changes to the capital gains tax rate that were announced in the budget. Now, the reason I'm dwelling on this and the business property relief changes are for those business owners who are thinking of retiring or selling, or even the farmers are all up in arms because they tend to keep theirs and they suffer inheritance tax instead. So I've covered both, but it's big changes for every business owner when you either exit or pass your business on to the next generation in your family. So first of all, I'm going to use the same case study for both, but we'll look at capital gains tax first, and then we'll look at the inheritance tax. Just before I do that, everybody's familiar with AI. We have it rammed down our throats every day on TV and in the press. None of the pictures from here on in are actually real pictures. We're trialing Microsoft Copilot, which is their version of ChatGPT. And I said, create me a picture of number 10 Downing Street, and that's what it came up with. So that is not number 10 Downing Street, and if you look at the real thing, it's probably nothing like it. But the rest of the pictures are all AI generated, so and some of them are quite interesting. So the changes to capital gains tax were quite simple. From budget day back in October, the main rates went from 10 and 20 to 18 and 24. And the rate of capital gains tax for trustees who tend to pay the higher rate of tax went from obviously the same, 20 to 24. But they gave us a period of grace on business asset disposal relief. You might be familiar with that. If you own a qualifying business and you sell it, business asset disposal relief gives everybody the first £1 million worth of gains a beneficial tax rate of 10%, whether you're a higher rate taxpayer or not. Well, they've said we'll keep that rate until the 5th of April 25. Then in the next fiscal year from 25 to April 26, that goes up to 14, and then it will catch up with the new basic rate for disposals after the 6th of April 26. So they've given a period of grace and a bit of a step up there for people selling their businesses up to the 6th of April, the 5th of April 26. And the case study picks up on all that. Now, this is the second AI generated image. And I said to Microsoft Copilot, I said, create me an image of a modern looking family with 2 children. And that's what it came up with. So I've stuck with it. Quite an interesting one, but there you go. Okay, so we've got Mr. and Mrs. Steele and their 2 adult children. And for the purposes of this case study, they own a manufacturing company. They've owned it for many years. The reason I've flagged that up is because they haven't really got an allowable cost. They set the company up with a couple of shares worth £1 each. So if they sell the business, they don't really have any cost to set off. So pretty much the proceeds will be the gain, which keeps things simple. Mrs. Steele owns 90%, Mr. Steele 10%. It's a manufacturing company, and they recently turned down an offer of £4 million for the company. Let's assume that was fair for the purposes of this exercise. Okay, so we're looking at it. What else do we need to know about them? They're both past retirement age, not really relevant. They've got a simple share capital, a single class of shares, and both have owned the shares for many years. Like I say, first reason for that I already explained. The second one is that will mean they qualify for business asset disposal relief if they sell the shares. They've both got more than 5%. They'll both be voting because there's a single class, and they both own them for more than 2 years. The 3 main criteria when you've got share ownership for business asset disposal relief. They've both got healthy income. They're both high rate taxpayers. So first of all, what if they'd accepted that £4 million offer for the business before the budget? So I'm going to be comparing what do they win if they'd sold it compared to what do they win in the different time periods when the budget takes effect. So again, there's numbers behind this, but she owns 90%, so she gets 3.6 million gross. She pays 100,000 on the first million because that's her business asset disposal relief kicking in at 10%. Then she'll pay at 24% on the balance, the 2.6 million. So she pays another 520, leaving her with 2.98 million. I won't go through the numbers with him, but of course he only owns £400,000 worth, well within his £1 million business asset disposal relief. So he only pays 40,000 tax. So overall, they get to keep 3.3 of the 4. And the effective tax rate is 17%. Now, I've put 3 dates in there. And I won't go through the detailed calculations, but you can see if they dither or they can't find a buyer and they sell between those time periods, top left, the tax take goes up considerably from the 620 on the previous slide. And you can see before this 6th of April coming up, it'll go to 724, then it steps up by another 40,000 each year as the basic rate goes from 14 to 18%. His does exactly the same, apart from number 1, because we've got that grace period where the business asset disposal relief rate is only 10%. So overall, their tax take is considerably higher than it was pre-budget. So you can see there the retained figures. So the effective tax rate by the time the full effects of the budget take place has gone from 17 to 22%. So it's quite a hike. Now, what could they have done? Well, there's loads they could have done, but I've just got one example. What about spreading shares around the family? Does it improve the position? Well, intuitively, yes, of course it does. But if we just have a quick look at it. So let's give them all 25% each. So where do they come from? Well, it has to come from mum. So if she gives 15% to her husband, and then 25% to the 2 kids. Now, obviously, we can't do anything moving shares around a family without thinking about tax, because what we don't want to do is make the eventual position better if we trigger a disposal now. So obviously she has given shares away. Now, a lot of people think that if you make a gift, you don't have to worry about capital gains tax. You do. If you do a transaction at under value, or if you do a gift or a connected party transaction, HMRC rules say that the capital gain is calculated ignoring any proceeds you got, even if it's nil, and it substitutes market value as the pretend proceeds, and you're taxed as though you'd received those full proceeds. So you end up with a dry tax charge if you've got a gift, because you've given something away, you've not received any proceeds, and you have tax to pay because you're taxed as though you'd received market value even though you got nothing. So here though, we're fine because they sought some tax advice. The gift to the husband is ignored for pretty much for these purposes. Husband and wife, spouses, civil partners are treated as a single economic unit, so there is no tax to pay. Husband simply pays any gain that had accrued on the wife's shares at some point when he sells them in the future. And because this is a trading company, and there are other conditions, but we're assuming this is a trading company with no non-trading assets on its balance sheet, the gift of the shares to the children can be held over, so we're fine in that case as well. So the effect is pretty much the same as giving the shares to the husband. So great, we've got over the first hurdle. We haven't inadvertently triggered a capital gains tax charge by giving the shares away. So how does that benefit everybody? Well, I've introduced another band here which is relevant to the kids, but not really relevant to these two, which is why 3 and 4 don't change. But obviously mum and dad have now got £1 million worth of shares each instead of 3.6 and 400,000, so they both just pay the business asset disposal relief rate on their entire sale. So they're both paying 100, 140, then 180. So you can see the tax bill's already significantly reduced for mum and dad. Slightly different for the children, because as I said before, the conditions for business property relief are 2 years ownership. Well, they haven't owned the shares 2 years, they haven't gotten it yet. So that's why I put the third one in. Now you might say, well, why is the husband's the 15% he received from his wife, why is that qualified straight away? Why doesn't he have to wait 2 years? And the rule is because it's on the person, not the shares. He already qualifies for business asset disposal relief because he's already got 10%. The amount you need is 5. So any he acquires after that immediately qualify. The 2-year clock doesn't apply, but it does to the kids because they own none to start with, so they have to own their shares. You have to own a minimum of 5% for 2 years. So for them, they don't start to benefit until year 4, which is 2 years from today, assuming she gifts the shares today. Okay. So overall, if they do nothing in brackets, if they do what I've just said, that's the amount that they retain on the left-hand side. Now, clearly there isn't a silver bullet. One size doesn't fit all. Everybody has different circumstances, and I'll cover that in a bit on the inheritance tax side of thing. But seek advice if this is something that concerns you or is relevant to you. Same family, let's talk about the inheritance tax position. There are 2 reliefs called agricultural property relief and business property relief. The word property is a misnomer. It's nothing to do with property, as in the building that we're studying. It is to do with businesses and trading company shares. Property is old language because this has been around for years. And basically, if you die and you have a qualifying business in your estate, it's ignored for inheritance tax purposes. Your beneficiaries in your will not suffer inheritance tax on the value of that business until the budget. So what happened in the budget was from I'll tell you the current. I've just told you the current. Sorry, I'm ahead of myself. And that applies to trading companies, farmers, and I think the reason farmers are perhaps more up in arms than traditional business, than manufacturing or trading company owners, is because farms are the one sector that tends to pass to the next generation. Whereas we don't have many. We do have a few, but I'd say it's more common that our SME clients sell up and retire rather than bringing the kids into the business and passing it on in the will or through lifetime gifts. But agricultural relief and business property relief, pretty much the same thing if you've got a qualifying business or farming business, and it exempts the entire value of the business from inheritance tax without monetary limit. From April 2026, that all changes. The 100% relief only applies to the first £1 million of the value. You've probably all seen this. And then it's 50% relief after that. So the rate of inheritance tax at the moment is 40%. So on the excess over £1 million, you're effectively paying, your estate is effectively paying 20% inheritance, is suffering 20% inheritance tax. There's a quirk in that at the moment, shares designated as not listed on the markets of a recognised stock exchange will be 50%. Think AIM quoted companies and similar. They're not fully listed, not fully quoted. At the moment, they qualify only at 50%, and they will continue to do so, and they will not benefit from the 100% on the first million. Equally, they don't waste the 100% on the first million. It'd be a bit unfair if they counted towards, if you had to use those, but then they couldn't benefit from them. So they are 50% on the full value of those shares, rather than benefiting from the 100%. So just to summarise, what we've got on the left is where we are now. Unlisted trading companies, including farming businesses, they're without limit. Shares on a market which is classed as not listed, AIM, they are without limit. But AIM is being moved into the category of the fully quoted businesses. Unlisted trading company shares, when the changes come in, any excess over the millions at 50%, and the AIM company shares do not qualify for the first million, they are going down to 50%. Sorry, I think I said on a previous slide that AIM were already 50%. They're not. AIM are 100% at the moment. The change takes them to 50 to align them with fully quoted shares. I apologise. So just a simple example before we go into the case study. The 1 million limit is apportioned across business property and agricultural property relief qualified assets, how you want to. Assets already only benefiting from 50% will continue to do so. And like I say, those assets will not waste £1 million. What else have we got? So if you've got a £3 million business now and you sell it, you die with it in your estate, you will have 100% relief on the first million, 50% relief on the second. So there's a £400,000 tax bill to find there by your executors that previously wasn't there. Now, that's fine, but if you die and you've only got the business, very often we see clients who live in a very nice family home. One of the kids wants to live there after mum and dad pass away. What if they've got to sell that to raise the money? What if they've got to sell the business to raise the money? And this is what the farmers are all up in arms about, because it will interrupt the continuity of the businesses flowing to the next generation, because they'll have this tax bill to find and no cash with which to settle a liability. So, Mr. and Mrs. Steele. The wills leave everything to each other on first death and everything to the kids, which is not the best thing to do. So before the budget, what would have happened is, without worrying about inheritance tax whatsoever, on first death, the shares could have gone from, let's assume Mrs. dies first, she would have passed the shares to her husband in a will. And as for capital gains tax, they're treated as one economic unit, so that's a nothing for inheritance tax. But on second death, he could have passed them tax-free to the children using this business asset disposal, using business property relief without limit. Now, when the changes come in, that all changes. There will be on that value of 4 million, because he will own the whole business once she's passed away and passed the shares to him. On that value of 4 million, there'll be a £600,000 inheritance tax charge that needs to go from somewhere. And like I say, where do they find the funds to pay the tax? So what do we do about that? Well, the first thing is, I noticed straight after the budget, everybody's probably familiar with the nil rate band. So when we die, we're all allowed to have £325,000 worth of value in our estate before our estate suffers any inheritance tax whatsoever. Now, for spouses, if the first one dies, passes everything to the survivor and doesn't use that, the second one to go can use both, the 650. Now, when this came in, there was loads of speculation about this £1 million. If it's not used by the first spouse, can the second spouse use it and use 2 million? Now, the only two organisations I didn't hear talking about this were the government and HMRC. So we can't really rely on the fact that that will, it may still come in, I don't know, but we can't really rely on the fact that that will come in. And I apologise if it's been announced in the last 3 or 4 days, because I should have looked and I haven't looked. But when I put these together last week, when I polished them off last week, because they're already sort of together, when I checked that nothing had changed, nothing had changed. But if it has, I apologise, I don't think it has. So what can they do? Well, the first thing they should do in that case is vary their wills. So the first one to go passes on at least £1 million worth of shares direct to the kids and bypasses the surviving spouse. And that will use the £1 million 100% band, which saves potentially £200,000 worth of tax straight away. Okay. Now, obviously, if Mrs. Steele's going to do that, she needs to give some to Mr. Steele, like we saw on the capital gains tax slides, because he doesn't own £1 million worth yet. So as before, she gives 15% to him, 25% to each of the kids. Again, we're fine from a capital gains tax perspective, because we need to have our north eye on that when we're giving shares away. So what happens here is when both of them go, they both leave their 25% to the children. And in effect, the children then have already got their 25% from the gift, which hopefully she makes today. And then the first £1 million is inheritance tax free. And you can see we've wiped that £1 million inheritance tax bill out. It's gone completely. Now, I'm not naive enough to assume that everybody can do that, because when I'm doing inheritance tax planning with people, it's a balance between what tax can you save when you die and how can we do something without harming your standard of living. Because there's loads of anti-avoidance rules that says if you give something away and you can continue to receive the income or the benefit of the asset, it doesn't work, it's clawed back into your estate. So it might be that Mr. or Mrs. cannot afford to live on only 25% of the dividends, although in most cases, if you use different classes of shares, voting shares independently on each class, you can avoid that. There is a slight risk, but you can do it. So it might be that on first death they say, well, let's compromise. We'll pass 25% to the surviving spouse, and then the surviving spouse will pass all of the 50% on second death. So a bit of a compromise. We will have £200,000 worth of tax to pay, but we've still saved the 400 by gifting these shares earlier on to the next generation. So I think the takeaway from this is it's going to be quite expensive for a few people if they do nothing, and hopefully it will focus people's minds into. I see people very often and they are quite reluctant to divest themselves of control and ownership of the company, particularly in a family situation. Whether somebody wants to retire and sell is slightly different. But if you're thinking of keeping your business, passing it on to the next generation, think about the capital gains tax planning, because if you're keeping it or selling it, it helps either way, and you've got a more CGT efficient way of selling the business because you've got ownership spread around the family a bit more. And if you decided you want to hang on in there until your last breath, then think about bringing the family in a bit earlier so that you can save some inheritance tax later on. So I think people will hopefully think about that, and they are quite chunky numbers of tax, particularly the inheritance tax. So another AI image. I said, could you please craft me a picture of a busy accountant? That's what it came up with. I do feel like that sometimes. So there are all sorts of changes in the budget, not just the capital gains tax and the business property relief and the stuff I've been through. But if any of that piques your interest, or if any of it's relevant to you, seek some advice. Thanks very much.